Good morning, everyone, and thank you very much for tuning into the CEO panel this morning. This is the second year that I've been asked to moderate this session, so many thanks to Tanguy and the team at Pharma for inviting me back. And what a year it's been since we were all in Brussels for this conference last year, and who would have predicted that we would spend the best part of 8 months working from home and that Zoom and Microsoft Teams would become the main method of communication with our colleagues and in some cases our families. It's been an incredibly tough period for everyone, not least the fund management industry, particularly early on in the crisis when investors took flight from funds during the painful market sell-off as COVID struck in March. Among the market turbulence, there have been some bright spots. Flows into ESG funds, for example, have reached a record high, and their performance has proved resilient throughout the worst of the crisis. No doubt we'll be touching on some of the implications that COVID may have for ESG over our discussion this morning. News of a vaccine certainly spurred markets into overdrive earlier this week, and hopes have been raised that there may finally be a route out of the pandemic, although the road ahead is likely to be a very long one. Well, joining me to discuss some of the big challenges, implications and opportunities for the asset management sector as we start to look beyond COVID, I'm pleased to have, virtually at least, a stellar lineup of CEOs this morning. Please welcome Naïm Abou-Jaoudé from Candriam, Gilbert van Hassel from Robeco, Aleksandar Ivanovic from UBS Asset Management, and Raby from Natixis Investment Managers. Thank you all very much for taking the time to join us this morning. Just a reminder to our audience members to send in your questions during the panel. I will leave some time at the end of the panel discussion to get to them, although with this being a virtual discussion, please feel free to pose any questions as we go along, and I'll do my best to address those and put those to our panelists throughout the session. Okay, so I'd like to really kick off by asking the panel really what the past 8 months have meant for your organizations. As I mentioned, we've all spent a prolonged period of time getting used to this new way of working and doing conferences virtually like this one, and some predict that we may never go back to the way we were. Perhaps I could start with you, Naïm. Just tell us how you found the past 8 months as a CEO leading an asset management firm, and just how tough has it been being a CEO during this period, and what have been the biggest implications or impacts on your workforce, perhaps?
Yeah, thank you, David, and good morning, everyone. It's a pleasure to be here. To be honest, I want to start with an example. Like 9 months ago, when everything started, I learned about Zoom with my son, who is 6 years old, during his classes, and he was on Zoom, and I said it's great way to communicate. And I contacted my IT and said there is something called Zoom, and we had really to adapt overnight to have 98% of our workforce working from home. And finally, I haven't thought that it was possible, and it was a great news. The second element that was key is really adaptability. And the third takeaway, it is really this crisis has impacted everyone and everywhere at all levels. And it forced us to develop much more empathy and humility in our day-to-day life with our colleagues, with our family, with our clients. And we tried to adapt in terms of communication and to over-communicate with the clients, to over-communicate with our people, because the level of anxiety and stress was so high. And we had really to give them a lot of comfort at all levels and keep the morale and upbeat in a period with a lot of stress. And I think all over, when we are still in the crisis, but I think the whole company and our industry has been very resilient and resisting very well compared to other businesses. Then we can be proud of what we accomplished as of today.
And Jean, as somebody who oversees a network of of affiliates, over 20 affiliates. I mean, how has the pandemic changed what you do? I know that you were someone who travelled quite a lot with your job, obviously around the world, meeting all your colleagues in various parts of the business. So how has it really changed what you do as a CEO and also as a business? How has the pandemic really shifted the way you communicate with staff, as Naïm's just talked about?
Well, I could touch on many points. But just start by organization of work, because I've been quite surprised by all the absolute statements I've heard about this. I'll just give you our own experience. Of course, at the outset of the confinement, of the lockdowns, we're all a bit surprised, pleasantly surprised. We were able to work from home, and I heard then that the future of work, it would never be the same, and everybody would be working remotely, and that was fantastic. Well, I always find that when in the middle of the crisis, the worst vantage point to see beyond the crisis. And 6 months later, what do I find? I find many of our staff who are now in lockdowns again in France, who want to come back to work, where we have to tell them, stay at home. That's the government order. I've got very divergent views throughout our group on how people approach working from home. Some people really like it, others just don't want it. And yes, it's quite varied by geography, because the approach of governmental authorities to the pandemic is, of course, different from one area to the other. And we've got to manage this diversity again. We have by definition, we're diverse by design, with more than 20 different affiliates, which each have their DNA, each their brands. But in terms of organization of work, it's different from one place to another. And sometimes it creates a perception of incoherence. And yes, as Naïm said, got to communicate why that is. And it's in large part driven by local circumstances. So we may be global in nature, but when it comes to adapting to the current environment, it's got to be local. The second comment I would make is that throughout this period, I have been very pleasantly surprised by the agility of our teams. Of course, in terms of adapting to new ways of communicating with clients, but also in the innovation. The way we organized new products, new activities that require capital, they're all centralized. They all come to what I call the federation at the level of NIM. So they all come at my level, and I'm stunned by the intensity of the innovation that this environment has created. So in one way, I'm always not skeptical, but I'm always worried if there's going to be fatigue, if there's going to be a loss of productivity. But insofar as innovation is concerned, the window I have today is quite positive. And I think also that's a reaction to the new circumstances we are living in. And I hope that this, of course, helps us leapfrog into 2021 on a good footing. I could go on and on and on, but I think we're 4 panelists, so I'll stop there with my opening remarks.
No, that's great. Thanks, Jean. And Gilbert and Aleksandar, any thoughts from you guys? I mean, Jean just mentioned about innovation and things being accelerated. I guess, the digital side of things. I mean, people have talked about this period really accelerating the move to digital. We've all moved on maybe five years faster than we perhaps should have done. Any thoughts from you about how this period will likely change what you do as an organization? I mean, do you ever see a chance where 100% of your workforce will be back in the office? And as Jean said, there are people that particularly want to come back to work but can't. And I think that's probably true of maybe a younger workforce, or people who live on their own, who perhaps want to get back and socialize with their colleagues. So how do you see this period really changing what you do for good? I don't know if you've got any thoughts.
Well, I mean, of course, I echo a lot of the comments that my 2 colleagues have already given. We were fortunate; we had invested very heavily in interconnectivity between people before that, and we already had quite a number of people that work on flexible arrangements. So we could very actively go 100% working from home almost immediately without too many problems. I think it's a bit too early to say how things are going to pan out. Of course, we are looking at it, we're studying at it, we're talking to our clients, we're talking to our people and see what comes out. I think, flexible work, working from home, it has proven that it can work and that it can work very well. So I think it's going to be part of the future. Is it going to be part for everybody? I don't think so. I mean, if you look at asset management, of course, the value creation to a large extent happens by portfolio manager, researchers, traders working very closely together, challenging each other. And that's a lot more difficult to do from home. And so, yes, I mean, just as Jean said, we have high diversity, people that absolutely want to come back, people that are absolutely scared to come back. A bit too early, but that flexible working and working from home is going to be part of the future, I'm pretty sure of.
And Aleksandar, any thoughts from you about how UBS has adapted over this period as well?
Yeah, I think it has helped us leapfrog some of the topics we already had on our agenda. I think digitalization was on the strategic agenda for all of us, but I think it has helped us really to step change what we were planning to do, and not just leveraging digital tools like Zoom, like all of the great gadgets that we have to interact with clients today, but also I think it triggered the change in mindset. I'm stunned how all of a sudden things that we were thinking was unthinkable is doable. PMs, traders working from home, distribution staff. I mean, we have proof points that this can work. Now, whether the pendulum is gonna swing, all the way to 100%, I can quite firmly say I don't think so. But it's not gonna go back to where we were before. And also, the fact that you can do your job really well from home. So the geographical proximity is not as relevant anymore. And also, to some extent, removing the stigma, because many of our staff actually do prefer to work a few days at home. So I think the pendulum will have to find somewhere, in the middle. And I think that's for us as an industry, by the way, an incredible opportunity also to attract talent, because that old model is outdated, and it might help us attract talent as well. So I think the one thing that I'd also say is that, all these big step changes aside, I was really impressed about the sense of togetherness, not just in families, colleagues, communities, and clients, but I think even among competitors. The dialogue we had among each other, I think, was another thing. All in a healthy, competitive way, of course. But I was also truly impressed and humbled by that.
That's interesting. I think it's an interesting point you make about talent as well, being able to attract talent. I think actually that there's a lot of positives to take away from this experience as well. Perhaps that's something that maybe the industry will take away as a positive. The fact that if you can offer more flexible working, this could be a sector and industry that can attract young talent who perhaps see it as maybe a sort of stay at work culture maybe. But it's certainly a few positives to take away from this experience, I would say.
Absolutely.
Okay. I'd like to move on now to touch on ESG. Now, this was something I mentioned in my opening remarks. And if we look at the latest Morningstar figures, for example, which show that assets in ESG funds have pushed past their record, I think 880 billion year to date, and performance has also proved extremely resilient during the crisis. I'd be keen to hear from the panelists about how you think ESG will change as a result of COVID, the focus on ESG, the opportunities to develop more products in this space as well. I know that a poll was conducted of the audience just before we started this session. I think the results here I have are that one of the biggest growth opportunities that the audience sees actually are in ESG solutions. I think around 44% of the poll respondents see ESG as a growth opportunity. So I think very interesting, actually, last year on this panel, one of the CEOs predicted we would see greater focus on the S factor in ESG. And I think this has certainly come to light with the onset of COVID. Gilbert, perhaps I could start with you. I mean, what impact do you think COVID will have on ESG from this point forward? Do you think, is it fair to say that the S in ESG really has come to the fore during the pandemic? And what does it mean, as we look forward from this point?
Well, it's pretty clear that that he has gotten a lot more attention. Has it become more important? Has it put climate on a second plan? I don't think so. I mean, I'm very convinced that these three letters, just as like the 17 SDGs, are completely interconnected, and that you cannot really optimize for one without thinking about the other three. And of course, now everybody is focused on health. That's what governments are focused on. That we as corporates are focused on. That's what individuals focused on. The next thing is going to be the economy. And clearly, I mean, if you want to have a recovery, for me, it needs to be a sustainable recovery, and that means that you need to really look at all three of them. I mean, you need to make sure that on E, the climate and biodiversity get all of the proper attention. On S, you clearly see what's happening in the world in the Black Lives Matter, the Gilets jaunes, and so on. Everywhere you have people, and it's not about police violence. It's, of course, that's the direct cause in the United States. It's about inequality, lack of opportunities, lack of access to great universities, and so on. And it's not only unfair, it's unjust. And without doing something about it, the E factor and the economy is not going to be solved. And then lastly, how can you run a country, a company, your individual assets if you don't have good governance? So for me, putting one after the other, I mean, they're all interconnected. You need to optimize for all of them at the same time.
Naïm, there's been a big focus on social factors, as we've just discussed, but as Gilbert alluded to, what does this mean for some of the climate-focused initiatives that asset managers have been working on? Gilbert doesn't seem to think there'll be any less of a focus on the E as we move to the S in ESG. What were your thoughts on this? I mean, has the pandemic served as a wake-up call that this is exactly the type of shock that we could experience in future as a result of the climate crisis? I mean, what do you think is the future for some of those climate-led initiatives that the industry has been so focused on up to this point?
No, I echo and agree with Gilbert, what he just said about the importance of E, S, and G. But the reality is this crisis has put the social aspect at the forefront, on the top of the agenda. But we have been focusing on S for the last 15 years. And the reality today is E, environment, and S are both of them very interdependent and interlinked, and we have to put them at the same level. And the reality is we have to continue focusing on the E, having an impact, positive impact on the environment, while avoiding social disruptions, because the reality, both of them are the biggest disruption we are having for the next 20 years, and we have to tackle both of them. And the only way to do it, it's about moving with a just and fair transition and trying to transform this recovery into something, into an opportunity with a green, growing, and inclusive economy, where we have to really create huge investment in order to be sure that the people who are going to lose jobs because of the move from the high CO2 intensive business to the green economy, we are able to train them, reskill them, and move them to a new businesses that with a lot of opportunities. And in fact, these investments are important. We have also to allocate our capital and our assets in another way and integrate the risk and opportunities of the ESG everywhere in the whole financial system. It has to be integrated. And we have a role to play as an asset manager and as a financial system.
Okay, Joanne, any thoughts from you? I know that tying this into the topic of sustainable finance, perhaps, and a desire among politicians and regulators for a green recovery. So if we look at earlier this week in the UK, for example, the government announced the issuance of the UK's first ever sovereign green bond. Naïm just talked there about the role the industry will need to play in the green recovery, so to speak. So what are some of the opportunities here for asset managers? How vital is it that the industry plays a role in the route out of this crisis and making that a green recovery, essentially?
I'm not sure you were addressing this to me, but I'm happy to take it.
Right, sure, yes, sorry.
I'll make a few observations. First, I think asset managers have clearly a role to play, but sometimes when I read the public narrative, I get the sense that asset managers will solve all the problems of the world. So we should not make false promises or create expectations that we cannot address on our own as an industry. I think that's quite important. Secondly, we have to recognize that it's going to take time. All of these issues have been long in the making. They'll be long in the resolving. And I think that ties in also to the need for a long-term approach to asset management and for asset owners and corporates to take a longer-term approach, because the transition will be long. And it's about digital transition, it's about environmental transition, it's about addressing the growing inequalities that we see in the world that the pandemic has increased. So we all have a role to play. It's going to be intertwined, as Gilbert and Naïm said. You know, many of these issues feed on each other, but it's going to take time to address. The urgency to act is now, clearly. The environment, I don't think the environment will be taking a back seat. I don't. Because even though, yes, social issues have been at the forefront, social justice and diversity and treatment of employees and need to manage flexibly, which is frankly a micro approach to the S of social. Climate change is here to stay. And it's not simply because carbon emissions have dropped by a few percentage points with the lockdowns that the things we're seeing in the environment and the weather patterns change and the trajectory scenarios will really be modified. So this is here to stay, no doubt, and clients really focus on it. But we also have to recognize that there's no single solution, no single mantra, and that it's somewhat subjective in the way you can accompany this transition towards a low carbon economy, towards less inequalities, towards better governance, although governance, I find, has been really part of the active asset management mantra for a number of years. Maybe it was not articulated that way, but it's really part of what an active asset manager does or should do.
Okay, Aleksandar, any thoughts from you about how this period may change the focus on ESG and again some of the opportunities that the other panelists have talked about there?
Yeah, I think a lot has been said, and I guess the one thing that I would add is that, and again, I think the crisis has probably accelerated the focus on sustainability. I think I would add on the S, I think we as an industry need to collectively think how to make it more tangible. The investing side of things. I think one of the reasons why climate has been successful is because it's much more tangible. So that's probably one thing for us to think about, how to look at the S and make it more tangible from an investing point of view. And the other thing I would also say, to us, sustainability has always been sort of the glue that brings generations together. And again, that has also put, even a bigger emphasis now on the back of the crisis with all of the, challenges and issues that have been going on. So I think as an industry, this is an incredible opportunity. This is what clients tell us as well. And I think we need to work together with the regulators as well to make sure that we have harmonized data. We can make it more tangible, because that's going to be, for us, we think the success, a key success factor for the future.
David, I would like to add, I fully agree with Jean that, of course, asset management by itself is not going to solve this. I think not a single organization by itself is going to solve this, but we represent a lot of money. And if you look at, IFAMA, the last numbers I saw that this audience represents about 17 trillion euros in total, and money speaks. And so, our money can speak in a number of ways. First of all, we at Robeco are convinced that if you understand ESG, that you will make longer term, better risk-adjusted returns. So I think, incorporating ESG in your investment decisions is a first time way that you can let your money speak. And that goes from simple integration to impact, to very green solutions and offering with more and more. And then a second way on how money can speak is we are all owners. And as owners, we can vote, we can introduce shareholders resolutions, we can engage. And I think that is the second way that we should be doing this. And, you know, active managers have been doing this for a long period of time. For passive, it's a little bit more complicated, but they will be getting there too. So I do think that we have an incredible role to play. And then the last thing is through education. You know, I mean, I think the biggest issue that we have in ESG is a mentality. People are looking at risk and return. And that has been the kind of Markovich way that we look at investment, or the Adam Smith or the Friedman. I mean, these are, you need to add another dimension. It's not only about wealth, but it's also about well-being. And what we are seeing across the world is that the definition of fiduciary responsibility is changing very dramatically. And you see that a lot in, for instance, the Netherlands. You see that in Australia. You don't quite see that yet in the US, but I think it's going to be coming everywhere.
You raise a very good point there, Gilbert, about the role of active managers here, and you know, as you say, money speaks. I think that is one area you're seeing a lot more communication from active managers about what they're doing when it comes to engagement and stewardship, and using their vote to really make a difference. And I think this is one question I'd like to ask the panelists, is really, you know, whether ESG is really an opportunity for active managers now, as we look across you know, performance and everything else. I mean, the coverage around active managers, whether it's fees, performance, hasn't been great. We're still seeing money going from, you know, to passive funds as well. What I'd like to really ask is whether this whole issue of engagement and stewardship is really a bright spot for the active industry, and really for them to make a difference and to really, yeah, prove their worth, essentially. Naïm, I don't know if you've got any thoughts on that.
If you may, I will answer to this question. I want to come back a little bit on our duty as an asset manager by bridging the gap of education and engaging and play our part. I think this is key. But the reality is today, to tackle the E and S, because we are talking about this, there is a real urgency to act, and it's a collective move. And it has to be done at all levels. We have to, the regulators and the governments will have a role to play in standardization, harmonization, and having a common language on reporting. And we have to help companies to have a standard reporting, because they are droning onto with the data they are receiving. There are 360 different reportings. And we have the client, the end investor, who are putting pressure in terms of active engagement. Pension funds are asking us to engage and to have a better measurement. And the millennials are also pushing in this direction. And we have a role to channel part of the assets into the real economy in infrastructure and project. Then I think it is a collective role and urgency to act in order to move forward. And really, I feel the heat, and we have to move quickly. Now, in terms of our duty as an asset manager, beside our fiduciary duty, we have to increase the dialogue with company to help them increase the risk and opportunity in the E and the S and the G. And this is what we have been doing for the last 20 years. We have a team dedicated for that in proxy voting, active engagement. And the reality today, the end investors who are asking us to move forward, to give them to be an active owner, proxy voting. They want us to report on how we are voting, how we are acting in the General Assembly. We are doing it on our own, but we are doing it also collectively with other asset managers, with my colleagues that are here around the table. Most of them are part of collective action, the Climate 100, the World Disclosure Initiative, about social, many initiatives. But the reality here is we have to vote, we have to play a role. We are present in 90% of the vote, where we vote for climate and we vote against when it's not there. And we have really to be an active owner. Candriam have been voting in 90% of the cases when climate is on the General Assembly, for instance. And we are also reporting through extra financial reporting. And this is what the clients are asking about, what we are doing and what is the impact that we are trying to generate. And this is really a need from the end clients today.
Maybe if I can add, David, you know, what Naïm just said, I think for us, and that's really something really interesting, going sort of back to what I said about making things tangible. You know, in 2019, we voted in 82% of the cases for resolution focused on climate issues. So the percentages are very close, But the question to us should be, why is it so close? It's because climate, it's tangible. We have very clear metrics how we collectively look and measure progress. I think if you want to bring the overall sustainable agenda really forward, it has to be tangible. And this is a point in case where we can sort of really show that's a proof point. And I think on that's how I believe as an industry, we need to think together with the regulators going forward.
A couple of you mentioned this issue of reporting as well. I suppose obviously all of you have global businesses, and I imagine that in each jurisdiction, one client's perception or interpretation of ESG is very different from another's. And I suppose this importance of data and reporting is something that really needs to be addressed. And you've talked about working with regulators on this issue. So perhaps we can spend a bit of time just talking about some of the challenges when it comes to the current landscape and the reporting requirements or whatever standard or framework you're used to using. How important is it there needs to be a global approach to all of this? And if ESG is to move forward to the next stage, clients are demanding it, you guys are all working on it. How important is this global approach to ESG, whether it's taxonomies or frameworks or however you want to call it? Jean, I don't know if you've got any thoughts on that at all.
Well, some of the issues we're talking about are global in nature. I mean, climate change, whether you like it or not, doesn't stop at the border. On the other hand, we have to recognize that by definition, there can be a divergence in standards depending on one regulatory environment versus another. Frankly, as an asset manager right now, I can tell you, maybe with the new US administration, things will change, but the Department of Labor regulations in the US, as they stand today, are a frein, I would say in French, let's say a headwind towards implementing and advocating for non-financial criteria in the way asset management manage money for retirees, for our retail clients, for institutional investors. And that creates a dichotomy that we have. We can be advocate, no doubt. We can lobby, no doubt. But at the end of the day, it's a fact of life that right now, the regulatory environment is diverging in some respects. Now, maybe the US administration, the new US administration, will have a different approach. We all hope and we all believe it may be the case. But that's going to be a real topic if it does not. And right now in Europe, as we have to deal with the evolution of the impact of Brexit, that's another layer to all of this. That being said, I'd like to believe that when it comes to climate change, we can find as asset managers, of course we advocate proper disclosures, proper standards, but at the end of the day, accompanying the energy transition, it's about facilitating investment in renewables, in technologies that lead towards a lower carbon environment. I mean, I don't need standards to recognize that this is something that we ought to be doing and recognize companies that have a plan to transition toward a low carbon economy. We can do a lot by ourselves, in my view.
Well, I would echo what Jean said. I mean, in the US, it's actually worse. For all ERISA regulated pension funds, the Department of Labor very clearly defines what fiduciary responsibility is, and it is maximizing return. So as long as we cannot, and we still cannot, have a very completely scientific connection between ESG and maximizing return, they're only going to do that at the fringes. And hopefully the new administration is going to help in changing that. In Europe, you have SFDR, and if I look at how many people in my company are actually working on that, it is almost as big as MiFID II was in terms of regulation and impact that it's going to have. And we're all working on reporting, but there is one thing that maybe we forget a little bit. To have great reporting, you also need to have great and consistent data. And that is an aspect that is still also a little bit problematic in the entire ESG world.
Naïm or Aleksandar, any thoughts on that at all?
I want to be a little bit more optimistic on I think Europe is moving in the right direction with the taxonomy, the NFRD for companies communicating on the data, a single point of contact for data as well, and the SFDR. It's true that there are some complications. The timing is not the best, but the reality is I saw this for the last 3 years. Now it's accelerating, and we will have a common framework in Europe, and we can lead the way and being really leader in order to have the rest following. It's true that we need the US, we need Asia, we need China as well. It's a global framework, I agree. The second element that where I feel that things are also evolving in a positive way, it's about the reporting standard. When we see the TCFD, GRI, and SASB working together, or the big four companies, auditors are relying on what exists in order to give a framework. And finally, we have today the IFRS, who is moving in the right direction. Then we have 3-4 main initiatives moving in the right direction. And I remember 3-4 years ago, it was only on climate. Now we are trying to move on climate, adding the social aspect, and on just transition. And in fact, things are going in the right direction. It is slow, in my opinion. We have to go faster. But we have really, I want to point out that Europe is moving, and it's great to see things evolving in this direction. And I'm confident that the US will follow, and part of Asia as well in the coming months and years.
But let's be careful not to be too prescriptive. I'll give you an example, which I always like to give, and frankly, people will say because I'm based in France that it's biased. Okay, but take the case of nuclear energy, and its related sectors. I have to believe that nuclear energy is at least part of the energy transition. At least. Well, if we have a taxonomy that qualifies it as brown or very bad, I think we're creating another headwind in what cannot be an abrupt transition. If it's an abrupt transition, we're creating havoc. We know that. It has to be an orderly transition. We'd like to believe that it's as fast as we can, orderly transition to a low carbon economy. If you take nuclear out of the equation, you create a further headwind. So let's be careful not to be too prescriptive either. Standards, yes, but that's where active asset managers can play a role, deciphering between these various options and having a judgmental view on what promotes a transition towards a low carbon economy. I'll give you another example. When it comes times to electrification of transport, do you believe Tesla gets us there, or the large car manufacturers who have credible plans to move their entire portfolio to electrically powered vehicles? It's a debate. It's a question. Again, let's not be too prescriptive.
Okay. I'm conscious we spent quite a bit of time on ESG so far. Aleksandar, any final thoughts from you before we move on?
No, I think the panelists have covered the main points already, and I'm a bit with everyone. I think money helps move the needle. It always does, as we all know. So the global the effort, the quicker we will be addressing all of these big challenges. But I would also say what Naïm and support what Naïm said. I do think at the European level there has been some good progress made. We are not there yet, but I think the journey is heading absolutely into the right direction. And I think, not being too prescriptive, I think is essential for all of us to have a little bit of leeway as we address these challenges.
Yeah, I agree also with Jean about prescriptive and the criteria that are put in the taxonomy and also in the NFRD. There are 32 criteria. It's a little bit complicated. Then we have to simplify it, give a little bit of time till the end of the year of 2021 to prepare, have the NFRD done before the SFDR. All these are practicalities, but the reality is things are evolving. And maybe I have another view is we need the same level playing ground for the world, maybe a low level, not too complicated, in order to have the US, China, and Europe all converging. Because the reality is, even if Europe is leading the way, it's representing 10% of the CO2 emission, China is 27%. And it's true that China has decided to move for 2060, maybe to be carbon neutral, but we need a conversion between all countries and it's a global issue. It's not a European issue only.
Okay, well, let's move the discussion on now from ESG. It sounds like it's obviously a great opportunity for the sector at the moment. So I can get that message loud and clear. One of the other interesting results here from the poll was looking at other growth opportunities, and one of the interesting stats that's come out of the poll here is really looking at product mix. So private markets, alternatives, less liquid assets. So perhaps we could look at some of the opportunities either from a product or maybe a geographical perspective now. And just a reminder as well to our audience, please do send in any questions you may have. I'd like to see some more questions coming through. That'd be great. Jean, perhaps to you, there does appear now to be a growing demand among investors for access to private markets and alternatives. What are you seeing now, away from ESG? What are some of the client demands that you're seeing at the moment when it comes to exposure to different asset classes? Are you seeing particular trends develop during this period?
Clearly, the trend or the debate that some asset owners or people with long-dated liabilities have is where interest rates are and where they're going to be. And when you compare that to the historical discounting of the liabilities some of the clients were using, there's a clear challenge. And therefore, the trend that we saw towards an increasing willingness of some of our clients to accept the trade-off between liquidity and return, accepting a factor of illiquidity towards generating a higher risk-adjusted return for their investments is clearly there and continues. What I think we have to do as asset managers is, of course, try to innovate and find right ways of packaging solutions for our clients in that respect. I'll give you an example. For the first time, we have put together one of our large fixed income affiliates, Loomis, not to name it, very focused on the liquid markets as a brand associated with fixed income products. And we have created a solution dedicated to the UK environment by combining that expertise with the expertise of one of our affiliates very involved in private debt. Therefore, combining a solution that provides exposure to both in a properly set up, risk-adjusted framework. I think that's what we have to continue to do because our clients will be facing that issue for some time. And that is, frankly, an important element in the retirement savings of all of us. Huh? And you could debate whether under the current environment, people are saving enough. And that our own contribution as asset managers is trying to put together solutions that capitalize on this illiquidity premium, if it still exists. Because the more people drive into it, theoretically, the less illiquidity premium there is. But there's nonetheless an appetite to explore new ways. Another way where we see increasing appetite is blended finance, where you combine ESG with public capital and private capital to actually promote investments that have an impact in these areas while ensuring a proper risk-adjusted return for private capital. Of course, that means leveraging public resources, but you do it in a way that actually creates 1 + 1 = 3 in terms of capital put to work in advancing some of the issues we've discussed, as well as ensuring a proper risk-adjusted return for the private capital. That's also an area where we see growing interest.
Okay, Aleksandar, maybe a question for you. I know that Tanguy made reference in his opening remarks to the 4 trillion euros that is sitting in bank deposits, and the industry really needing to do more to attract this money into funds and products. So, Jean mentioned there the sort of focus on solutions and other products to cater to client demands. Do you see this as a period where asset managers need to step up their actions when it comes to innovation? Again, what are you kind of seeing at the moment in terms of client demands, and how are you responding to that?
Well, I think on a macro level, we are probably challenged with another decade of low growth, low return environment. And that means that there will be ongoing pressure in the traditional space, right? And people will be willing to pay up for differentiated return streams. So I think at a macro level, these are the trends, and they then manifest themselves in different formats. So the demand for private markets is nothing else than people seeking, returns, differentiated returns, and they didn't have access to that asset class. And again, I do believe there is going to be tremendous demand for private markets, across all types of investors. we also believe that, especially in Europe, that wave of passive investing is probably just in its, in its middle stage. There's much more to go. I hate to use the term barbell, but there will be an element of differentiation, clear differentiation, where people are willing to pay, and probably focus on fees and value for money, because we live in an environment where generating returns will be tougher. And I think people also are willing to explore different, not just asset classes, but also geographies. I can tell you that, what we have seen in terms of demand for China in particular, and emerging markets, not just in equities, but also fixed income more recently, because Chinese fixed income, it's the one of the very few places where you still get a real yield. So, that agility to really navigate different asset classes, that's what clients are looking up as well, and asking us to help them navigate that world. And I think it offers opportunities, for us to deliver what investors are looking for with the expertise that we have, on the ground.
Okay. Gilbert, Naïm, any thoughts from you at all?
Well, I think, echoing what my colleagues already said, alternatives, private markets, very highly in demand. People willing to take the illiquidity risk or the liquidity risk in return for return. But I also would look at this low interest rate environment, which we may see for a while longer, as a real opportunity to start unlocking all of that savings that are controlled by banks and insurance companies until this time. I mean, people are really looking for different return, and for return in the first place. So, I call it TINA. There is no other alternative than to actually start going and start investing. And I think that people are going to start realizing. The other thing is, of course, I think that passive is a solution for part of your assets. I'm a firm believer in active management. As long as returns are low, the difference that alpha can generate is bigger than in a high return environment. So I think these are particularly good times for active asset managers. And combining ESG in all of these products is clearly also a great opportunity, but we've already talked about that.
I'd like to ask a question that's come in from one of the audience members, and we've talked a lot about less liquid assets. And I think one of the questions that's coming here is quite pertinent. So the question is: Do panelists see any potential in the LTIP framework, and should there be more incentives, fiscal incentives, to get people to invest more long term? Now, obviously, the LTIP structure was one that was lauded when it was launched as a kind of way to encourage more capital flows into a structure that would invest in less liquid assets, but that doesn't really seem to have taken off in the way that people were expecting. So I'd like to ask anyone if they've got any thoughts there. But also, I suppose a question that ties into that is really, does it make sense to promise investors daily liquidity when funds are invested in less liquid assets? So that is something. Sean, I can see you put your hand up. You'd like to answer that one. This is an issue that has come to the fore, particularly here in the UK, with Neil Woodford and some of the investments that he made into startups and less liquid companies. Jean, let's start that one with you.
I'll tell you, on the issue of liquidity, daily liquidity, I've been quite vocal. I just do not understand anymore why we continue to make daily liquidity in UCITS, in collective investment vehicles, in mutual funds, call it the way you want, a mantra. When we advocate to clients, think about financial markets in the long term, that you should really put capital to work in the equity markets. I'm talking the equity markets, public equity markets, for the long term. Is daily liquidity really, really that consistent with the underlying message? And particularly in an environment, in a public narrative, where we all as asset managers, or at least active asset managers who believe in some of the considerations we've debated, really, we have to recognize that this has to be a long-term approach. And the flip side of that is, do we really need, from corporates in which we invest, quarterly reporting? We're basically saying to management teams, we want to judge you on a quarter-by-quarter basis. Transparency is fine, but is the measure of success a quarter when it comes time to these considerations? I really think we need to think about these two things as related to one another, because the consequence of the facet of the underlying issue I see in the financial markets, i.e. that they are too short-term in nature, and we need to find ways to communicate the importance of a long-term approach to these issues.
That's right. I think actually we're seeing that here in the UK as well. We look at property funds, for example. The FCA here are proposing that investors need to give, I think, up to 180 days notice before they pull money from a property fund. Obviously, a lot of those funds have been suspended during the coronavirus pandemic. So, do any of the other panelists agree with what Jean just said about this focus or this obsession with daily liquidity when it comes to the UCITS fund structure? Does it need an overhaul? Should we be actually thinking about maybe imposing more restrictions, or perhaps time limits when it comes to redemptions?
It's less about making it, it's about variety. It's about variety. You can have daily liquidity, but there also should be a promotion of less than daily liquidity funds to invest in the long term. That's what I'm trying to do. More of a balanced, flexible approach.
Okay. Anyone else on the panel have any views on that?
No, I think it's a good point. The short-term horizon of our system vis-à-vis the long-term investment, I think, is key for companies, for asset managers, and for the financial system. One of the challenges we are going to have is really this low interest environment will last for the next 3-4 years, and there is a lot of cash sitting in deposit in banks, and the level of investment of the end investors is very low today. Then we have to really, it's about education, it's about channeling part of this asset into liquid, because there are some solutions generating or equity or thematic product with strong structural trend where they can play. It can be in ESG or it can be in any aging population or whatever. And we are seeing a lot of assets that are flowing in this asset class that we are developing, and we have been developing for more than 10 years. And the liquid assets are also key to have between 5 and 10% in the portfolio. LTIF is one of the vehicles that can help, and hopefully we can continue developing the liquid and the illiquid with different kind of NAV and less liquid assets as well.
That's right. Actually, I failed to follow up on that question about the LTIF. Gilbert, any thoughts on that at all? Whether there is potential for that structure actually to really take off?
Well, I mean, I just echo what my colleagues have said. I mean, totally of the same opinion.
Okay. Let's look at some maybe geographical opportunities now. And Aleksandar, you made a good point about investors being more open to the idea of investing in China, in Chinese equities, for example. I'm seeing a lot more coverage around managers making a concerted push into Asia, into China, gaining licenses to operate there in the local market. How big is China going to be in terms of the future for future growth of this sector? And is it the biggest growth sector? I mean, are there still opportunities to be had here in Europe when it comes to raising assets, or is China now the one market where everyone is really ploughing their efforts and expertise to try and win assets?
I think it's an opportunity on both fronts. It's an opportunity for European investors to invest in China and benefit from that tremendous momentum that the country is showing, and is probably still going to show for the next decade or so and longer. And I think especially the larger asset managers who have an established brand, who are known for quality and safety, that's an important role we can play to facilitate that allocation of capital and help savers here in Europe generate some additional returns. And then there's the other side of that coin, which is really China as a market where we can bring the other side of the equation, where we have alternatives, we have, we can talk about sustainability, all of these things importing into the asset management industry in China and tap into that client base. So we firmly believe, and that's why we have been investing for over 2 decades in China, that this is, if not the biggest, one of the biggest opportunities for our industry.
Okay. Jean, you had your hand up there, you about to say something?
Yeah, I mean, just I'm going to say the evident. Asset management is a GDP growth business, in which GDP, you can debate whether or not that's the right measure of success in today's world, given the considerations we've discussed, but it is for the time being. And it's a GDP growth business. And when you think about where growth will continue to be at the higher level than in other parts of the world, but it's less mature environments, less mature economies. And of course, China is part of that. When I look at all the, I mean, I don't have a crystal ball, but when I look at all the studies that have been done, the consultants, blah, 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 and the actual growth in financial assets, clearly China is an opportunity that I guess collectively we all look at. We address it in probably very different ways. And for us, Natixis investment managers, of course, we are trying to capitalize on financial assets invested that are by China outside in some of our strategies. But of course, playing in the domestic market also has an attraction. And it's a question we ask ourselves clearly, how best to play that opportunity. That being said, the largest asset management market in the world for the time being remains the United States. Let's not, so it's, I guess we all want to, at least as far as we're concerned, given our global nature, we think we can walk and chew gum.
Okay, Naïm and Gilbert, any thoughts from you about China or the US market or any other market that have opportunities lay?
Well, we are looking at China very carefully. Clearly, investing in A shares we've been doing for a while, looking at the number of large institutions that exist in the China market and that can invest outside of China, where we have been doing for a long time and have many clients there. The big question is, how are you going to approach a domestic market? It's you should not, I think, be fooled immediately by the size and by the growth rates in there, because it takes a very long time. And if you kind of look at how, for instance, IPOs are done and all funds are done through IPOs, and you kind of look at the most successful done by a foreign manager, and it is the largest foreign manager in the domestic market, was about 15 million. So you kind of look at that. It's going to take a long time. It's going to take staying power that you need to have. You cannot get into China and then get out because they will remember. It's going to take quite some investments, and you shouldn't expect on that domestic market very quick return, unless you go to a partner, and most of the interesting partners are already being scooped up. So it is a big opportunity. Everybody is looking at it. I think it will, like in most Asian markets, require quite some courage and quite some staying power before it actually pays off. And that's the domestic market.
Yeah. Naïm, any thoughts from you? You're about to say something.
Maybe because we covered the point, but we are focusing more on our core markets. Europe is a key market for us. It's still 27% of the assets of the world. Even if the expected growth is 5%, it's still a huge market with ESG. The savings are high, and there's a lot of cash in deposit. Then I think it's a huge opportunity. The US market is 48% of the world. We are working close to our shareholders to enter and develop the market into distribution and institutional business. And we are also covering Japan mainly, where we are investing a lot in Japan as a huge potential market with low interest rate environment. These are really the three core focus for us today.
Okay. I'd like to move on to ask you something about technology now, which is another issue that a lot of asset managers are focusing their attention on. And it was about three or 4 weeks ago, I was on a panel with, or a discussion with the JP Morgan Asset Management CEO, who mentioned that they'd spent about $400 million this year alone on technology, which sounds like a huge sum compared to the overall take budget for the bank. Obviously, it's pretty small. But the message that they were keen to get across was that those managers who really invest in technology will be the ones who lead the industry in future. Now, obviously, this past 7-8 months have obviously required a big shift to digital, and I'm sure that you've all scaled up your tech expertise to some extent. But I just wondered, does anyone have anything to say about how how they're allocating more resources or investment to technology, and whether that's data systems to help portfolio managers or the way you assist distribution. There does seem to be a bit of a discussion going on now about getting closer to clients, and a lot of firms are investing in D2C platforms, etc. So really it's just to focus on technology. How much importance are you placing at the moment on tech spend? How does that really compare to maybe 3-4 years ago? And I think in a lot of the consultant reports, the number one spend was always on regulation and compliance. So how has it shifted over the last maybe year or so, and particularly during this period of the pandemic? I don't know, Naïm, whether you want to start with that one or someone else on the panel.
I'm happy to start, but we have the one who doesn't embrace technology. I think we can lose the game today. We don't have the choice, and it's everywhere. It's at the level of the product and the investment. We are investing a lot in artificial intelligence, quant digitalization, in our platform as well, because we are facing a lot of challenges through the robotic, RPA, and also artificial intelligence in order to gain in efficiency. And with the relationship with our client, Robo for advice, digitalization, all these are key. We are not moving into B2C. We are doing the B2B today. We are only focusing on B2B and using digitalization as a tool to improve the relation with our B2B instead of going B2C. Then B2B2C, and the digitalization is one of the tools to support the relationship. I'm happy to cover the client relationship, but maybe we can I will leave the floor to my colleagues.
Gilbert, any thoughts from you?
Sorry?
Yeah, I mean, clearly very important. And I think, from three perspectives, I mean, first, the investment side, investing heavily in machine learning, artificial intelligence, cloud computing, alternative data sets, non-correlated alpha. I mean, all of those require that you invest in technology. There is the operational side where a lot of it is done in terms of robotics. What can we do there to become more efficient? As cost rise, there is then and fees and fee pressure is incredible. You really need to become more efficient. And then lastly, of course, on the client side, we're also more an institutional asset manager, so institutions and wholesaling. But a lot is being done in terms of getting better client reporting, making sure that your websites are interactive, that just like the big tech companies, what your clients are looking at, that you target your marketing more to them, you get them better reporting, you share your research in a better way. So yeah, I think tech is hugely important and has become ever more important.
Okay, Sean, you want to?
Yeah, a couple of observations. Maybe they'll self-evident to everyone, that being said, so I'm not sure it's very original. But yes, of course, the pressure to spend on technology and digitalization and digital transition is only increasing. It's not abating. But as a leader, it's about managing is choosing. Because yes, we have many considerations to take into account, be it the pressure we see on the top line, the increased cost of addressing other parts of the regulatory environment, be it in compliance and risk management, etc. So from our perspective, what we try to focus on is targeted tech investments, targeted investment in digital transition across our operations, some of which at our level of our centralized platform, others at the level of the affiliates, with hopefully always as good analysis as you can of the clear business benefits you generate. And that from distribution to trading and middle office operations to the investment decisions, as Gilbert mentioned, to back office, to business support. And RegTech has a role to play as well. So it's really finding that balance of the long-term benefits you see in these investments and the short-term challenges of making the capital allocation you need to do and should do, despite other headwind factors or other considerations that you need to cater to in the short term. And that's what management is all about.
Okay. I've got a question here from one of the audience members. I don't know whether maybe Aleksandar you could answer this one, but the question posed here is that there seems to have been, I guess this feeds into technology in some respect, that there seems to have been a lot of hype around robo-advice, and that is something that we have seen quite a bit of a hype around. How much of it is being used today, and what does the future look like for robo-advice? Is that something you can perhaps address? I do remember seeing quite a lot of coverage around robo-advice about 18 months ago, 2 years ago, but it seems to have died down somewhat, I think.
I think that really depends on where you sit, and is different from my perspective. For example, if you compare the US versus Europe. And that is also a function of the pension system. So if you manage your 401k plan in the US, having a robo-advisor, that sort of helps you make asset allocation decisions is clearly fits into the overall value proposition of managing your pension money. If you're in Europe and you are a participant of a DB plan, that robo-advisor value proposition is much less relevant. And as long as we have a nascent DC landscape in Europe, it's probably going to play a less important role compared to the United States. Now, having said that, we firmly believe in the combination of man and machine, which is why all of the data and AI analytics that we have are integrated in the investment process. And that also means that we also firmly believe that from an end client perspective, the robo-advisor will play an important role going forward. But the trajectory in different parts of the world will be different.
Yeah, I think that kind of feeds into another question, which I really should address from the audience here. So I think the poll that was conducted just before we started this panel showed that just over 80% of the audience believe that asset managers should be building more D2C platforms. That's a huge percentage, 81% of the audience. So what are the views of the panel on that? So should asset managers really be focusing their attentions on getting closer to the end clients by building these D2C channels? Jean, Naïm, Gilbert, any thoughts on that at all?
I mean, clearly we are not a D2C business. We are a B2B2C business. And yes, we're asking ourselves that question. Should we think more along the lines of a D2C distribution model? I think there's no fast and hard rule here. And in some situations, I think an intermediary platform is probably the better way to address the end client needs. In other situations, ourselves, as we think about growing our business and capturing share, yes, we think about D2C. But let's face it, it's a different distribution model. And do you have the right DNA to do it? We're asking ourselves that question, and it requires a different approach and significant investment. So, I don't believe D2C is necessarily a bad model. I don't believe it's necessarily the best model. As always, when it comes time to address money issues, there may be different approaches for different type of clients. I'd like to come back to the robo-advisor point, if I may. It's interesting because you might think that the younger generation who stands to inherit trillions of monies over the next 20 years, it'll be the first huge transfer of wealth from the generation of baby boomers, of which I am, to our kids or grandchildren. And that particular constituency is very tech savvy. But when you survey them, when it comes time to managing their money, they want to talk to somebody. So there's still a future for the human element in investment management.
I think you're right. I think that there have been studies that have been done where I think actually the process of investing via robo-advice platform will get to about 95% complete, and then before they click the invest button, they want to phone somebody up or talk to someone human. You're absolutely correct. Naïm, you've just come off mute. You're about to say something?
No, I wanted to say that it's not part of our strategy, the B2C, because you have three issues today. The administrative aspect is complicated, KYC. You have a captive business in Europe for the time being. And you cannot sell complicated product. You can sell money market product, and you can do transaction, debit, and you cannot sell add value and real solution like we see our business. using a robo-advice as a tool, yes, but not as a real strategy. And the last point I want to really point out is trust and brand are key. And even if today we see the communication digitalization is improving, our sales are happy, they can cover the whole world, we are doing it without any issue to cover our existing client, our existing relationship. When it comes to new relationship to develop prospects, it's much more challenging because the clients they want the real relationship, the one-to-one. And finally, we are ending up in a hybrid model where it will be more flexible, more digital, but the human touch, the trust, and the brand will remain, and the old style will remain, and this is key. It's the basic of a relationship.
Okay, well, we're down to just under 10 minutes left of the panel, so I'd like to get to as many of these questions that are coming from the audience as possible, and please do send in some questions if you haven't done already. This is the question relating to our discussion around ESG, and also it feeds in as well to the opportunities that you were mentioning, Aleksandar, in Asia. The question here is there a risk that ESG funds will have a bias against Asian equities in case Asian companies do not disclose the necessary ESG data? I wonder if that's something you might be able to take, Aleksandar.
Yeah, look, I think something that I can maybe share, the pace with which all of these elements are incorporated in some of the Chinese companies is actually quite staggering. So one doesn't preclude the other. Fair to say, different starting points, but it is interesting to see how quickly some of those local companies have actually embraced that topic and are working in very tangible steps towards it.
Yes, and I would echo that sentiment, and the lack of data, I think, is not a proper excuse not to invest in companies. I mean, as soon as you invest in them, you have a voice. You can vote, you can engage, and can improve it. And you've seen dramatic improvements, particularly on the governance side in Asia.
Okay. Changing the subject completely, another question that's coming from the audience, and this was something that I addressed last week in a piece that I wrote on Financial News, which was looking at the potential overhaul of existing delegation rules, which the response to the article was quite mixed, to be honest. People told me that it would never happen. The European Commission would never have an appetite to open up UCITS and rejig the delegation rules. But I wondered if the panel might have a view on how serious it is, or how serious are you taking this issue that perhaps delegation rules could be potentially overhauled, and this was something that was raised by ESMA in their letter to the Commission earlier this summer in relation to the review of AIFMD. You all operate global businesses. You have portfolio managers around the world that manage your funds based in Luxembourg and Dublin, other European jurisdictions. Are you concerned about the rhetoric that is coming out of Brussels when it comes to delegation, potentially overhauling a framework that has proved very successful and allows you to do your job and your portfolio managers to do their jobs around the world? Any views on that at all?
Well, I think let me maybe take a first crack at it. I think that our industry is basically based on, to a large extent, on outsourcing. We do want to manage money, and we want to take care of clients, and everything else from a Robeco perspective is something that we don't necessarily need to do ourselves. And then being global, you need portfolio managers and researchers, in Asia and US and so on. So wanting to impose European rules, and in our case Dutch rules, on other jurisdictions is probably not the smartest thing to do. We really need those different locations, and it's not as if they don't have regulations and are not proper regulated and are not properly acting. So yes, I am concerned about this.
And maybe if I can echo that as well. I mean, of course, we are concerned. I mean, at the end of the day, we're talking about choice, expertise, and efficiency. And it would undermine all of these points if we were to move away from a concept that I think we all collectively believe has proven the end investor very well for the last, since inception. So, to use that as a bargaining chip, we are concerned about that. Absolutely.
I've got a question that's coming from the audience for you, Naïm, and I guess this goes back to what you were saying about the need for the human touch, if you like, people still wanting to have interaction with human beings when it comes to investing. The question is here is that will retail consumers, still be prepared to pay for this human touch, and how does that reconcile with the need or the growing demand for cheaper products as well? So how do you factor in all this, when there is a demand from investors that they want cheaper products, but at the same time they want this human element that comes at a cost as well, I guess?
No, it's an excellent point, an excellent question. It's part of our challenges today. We have cost increasing, our revenues going down, low interest rate environment, and passive management is coming to challenge active management in terms of cost. And clients are not willing to pay today for if there is no real add value or real alpha generated. Then I think the question, it's a fair point. It doesn't change. We are adapting in our 3 pillars in terms of the client experience, in terms of our efficiency of managing the business, and the client relationship and the trust will remain. We are an active manager. We are in the middle, a sweet spot. We manage 150 billion. We are not a big one, but we are succeeding to generate alpha by being nimble and flexible and adding value for our clients with the client touch. And we have been growing by 10% every year for the last 6 years. We doubled the assets. Then you can be an active manager, you can add value and compete with low fees because the market is going like this, but you have to create a real add value for your client.
And I think that's an excellent point to maybe finish on, if we can maybe tie up the panel with a thought on this. So you talked there about delivering value, delivering alpha, and I suppose the question to ask really is that active managers really have been struggling performance-wise. And I think if we look at the flows into ETFs, for example, this year, I think the latest figures show $69 billion, I think, into ETFs in Europe alone this year. There was a lot of talk around the start of the pandemic that this was a great time for active managers, to take advantage of the volatility in the markets. If you look at some of the reports that have come out, during this period, I think there was a report by S&P which showed that during the first 9 months of this year, I think it found that no more than 60%, actually 60% of US equity funds have underperformed the S&P 500 during the 9-month period. So the report concluded actually that it was quite a striking quote, that it was a lot for active managers to navigate and most were not up to the task. So what do you see as the future for active managers? I mean, what do you say to that comment that active managers just weren't up to the task of performing during that 9-month period? I imagine that everyone is going to be fighting for survival if we can't carry on in this situation where such a large proportion of funds are failing to beat benchmarks. So what is the solution? How are active managers going to get better at what they do and differentiate themselves from passive? Why not just invest in a passive fund? Jean, any thoughts from you?
Well, I don't think we can do justice to this question with 1 minute left in the panel. Okay, I'll tell you what I will just react to what you said. Over the past 9 months, let's face it, the ability to do proper value discovery and price discovery has been somewhat skewed by the immense amount of financial stimulus that has been provided indirectly or indirectly to financial markets. So that may be one explanation why you see active asset managers, and frankly, I'm not debating a statistics, but I could, because at the end of the day, it's easy to have a headline grabbing approach, but then when you go into the detail, I always give this example. When you say large cap US strategy is probably the most efficient market you can imagine, sub-market you can imagine. Raby statistics tells you active asset managers underperform. But then when you take out, when you look down the line, net returns, when you take out those that are closet indexers, when you take out those that have low tracking error, then you find yourself in a situation where true active asset managers actually outperform. And the debate we have as active asset managers, or at least the challenge we have, is to make our voice heard more, take away the debate from just the simplest headline of management fees and go into the value for money debate and the net return to investors. And I think when you get people to focus on that, you get a different answer.
Yeah,
but I'm trying to be succinct given we have no time.
That's fine. That's a fantastic way of answering that question. You mentioned value for money, and obviously that's a big focus now, particularly here in the UK. We have the value for money assessments that are being put out by asset managers. Any final thoughts from Naïm, Gilbert, or Aleksandar on that point?
No, I mean the headline is a headline on averages. And if I look at everything we're doing, we're extremely focused. We have a quant business and a non-quant business. The quant business is absolutely going to a quant winter. And that is the case, I think, for almost every single quant manager, as factors, all of them have not been working. The active side of the business, every single one of them, with almost no exception, has outperformed. So, the debates and in general and on average, I agree, it's factual, but you have to make a distinction.
Naïm, any final thoughts from you?
There is a space for passive management and active management, and at the end of the day, maybe it will be core satellite. Today, passive management is growing, but there is a limit in growth. And more you have passive management, more you have inefficiency in the market, more you have concentration, and an active management can take advantage of this. And at the end of the day, it's about creating value and real alpha for the client. But it's all about the challenge we are facing, and we have to continue focusing on the support, on the product and the client experience, and being completely focused on what we are doing every day.
Okay. Aleksandar, I'll give you the final half a minute if you've got any final wrap-up thoughts to.
I'll appreciate the honor, David. No, look, I think our promise to our clients is everything, and that determines the long-term success of our industry. But differentiated returns come in different shapes and forms. So, alpha is one thing, but there are different elements that we contribute here as well. And delivering on that promise is absolutely essential. And maybe finally, on that entire topic of cost, I think the debate really should be about value for money. And as my colleagues have said on the panel, that should be the central point and not fees per se. And in that tune, I think there is space for the globals. There is space for people who are focused and dedicated to one specific area of the investment landscape. So I think on a bright note to end this panel, I think there is room and growth for all of us to contribute to this.
Okay, well, that's great. I think it's very good to end on a positive note. So thank you very much, Aleksandar. We've unfortunately run out of time. We spent the last hour and 20 minutes debating a range of topics, and I've really enjoyed the discussion. I hope you, as audience members, have also enjoyed it. And thank you very much for your questions, some great ones that came through. Unfortunately, I couldn't get to all of them. But thank you very much for your participation. I'd like to thank as well Jean, Aleksandar, Gilbert, and Naïm for their participation and input into what I think has been a very engaging, wide-ranging, very interesting discussion. So without further ado, I'll hand back to Tanguy now, and please do enjoy the rest of the conference. Thank you very much for your time.
Thank you.
Thank you, everyone.